Does any of this feel familiar? You know, a technology that's supposed to change the world, stock prices that only seem to go up, and this frantic, almost desperate rush to pour money into the future. Today, of course, it's all about artificial intelligence. But if you were around a quarter century ago, it was the internet. And the big question everyone is asking right now is, are we in an AI boom that's going to reshape our world for the better? Or are we riding a massive AI bubble that's about to pop, just like the dot-coms did?
All right, so to really get this, we've got to jump in the time machine and rewind the clock. Between 1995 and 2000, the tech-heavy NASDAQ index went on an absolute tear. It seriously felt like a party that would never, ever end. Until, well, it did. And it ended in the most spectacular way possible. When the music stopped, it was just brutal. The index completely cratered, losing 78% of its value and wiping out trillions with a T, trillions of dollars of wealth.
And the aftermath? Wow. It was a graveyard of ambition. You had companies like Pets.com. They had that famous sock puppet mascot. They even ran a Super Bowl ad. They became the poster children for this era of incredible hype with, let's be honest, very little substance. They had these sky-high valuations one day and then, poof, they were completely gone the next.
And this quote just brilliantly captures the mindset at the time. This was an actual headline from the Wall Street Journal, okay? It basically suggested that profits, the literal foundation of any sustainable business, were an old-fashioned, quaint idea. The new mantra was just get big fast. Burning through cash to grab market share wasn't just okay, it was actually celebrated.
Okay, so let's fast forward to today and see if history is rhyming, if not repeating itself. Right now, we are smack in the middle of another technological gold rush. And this time, it's all about artificial intelligence. And the excitement, you can feel it. It's palpable. But so are the echoes of the past.
I mean, the story is almost identical. AI isn't just being sold as a new product, it's being pitched as a fundamental shift in literally everything. How we work, how we live, how we create. And this belief is driving a tidal wave of money into the market, sending the stock prices of a few key companies into the stratosphere. It's creating this really unnerving sense of déjà vu for anyone who remembers the year 2000.
And listen, it's not just us casual observers getting nervous. Michael Burry, the investor made famous in the book and movie The Big Short for betting against the housing market before the 2008 crisis, he is now taking aim at AI. His firm has been placing some pretty significant bets that shares of major players like NVIDIA and Palantir are gonna fall. When a guy who is famous for spotting bubbles starts making moves like that, people tend to pay attention.
And the sheer scale of the investment in this new arms race it's just hard to wrap your head around. Microsoft alone is pouring $120 billion into its data centers. This isn't just about expanding, this is about building the foundational infrastructure for a whole new era of computing on a planetary scale.
And it's not just Microsoft. Meta is signaling that its annual spending could soon blow past $100 billion. To put that in perspective, that's more than the entire economic output of many countries, all being funneled into Mark Zuckerberg's quest to build what he calls personal superintelligence. And of course, Google's parent company Alphabet is right there with them. They've nearly doubled their own capital spending in a single year to build out these massive server farms needed to train and run their next-gen AI models. They're all in this frantic race, and it seems to be driven by this fear that if they slow down even for a second, they'll be left behind forever.
Now here's where it gets really interesting and kind of weird. This spending spree isn't just benefiting big tech. The stock of Caterpillar, the construction machinery company, it surged. And why? Well, because these massive new data centers need an incredible amount of power, and Caterpillar makes the backup generators that keep them running. It's a great reminder that in a gold rush, sometimes the people who make the most money are the ones selling the shovels, or in this case, the generators.
So, with all this money just flying around, how do we tell if we're paying a fair price for the future or if we're just buying into pure, uncut hype? To do that, we kind of need to check the market's vital signs using some classic investor tools. All right, so let's quickly talk about the PE ratio. In super simple terms, it's a price tag. It tells you how many dollars you're paying for just $1 of a company's annual profit. So a really high PE means investors are expecting huge growth in the future. A low PE might mean you found a bargain or a company that's in trouble. Now, When we apply a long-term version of this metric to the S&P 500, which is basically the scorecard for 500 of the biggest U.S. companies, the warning lights are flashing bright red. The market's 10-year PE ratio is nearly double its historical average. Statistically speaking, it's what's called an extreme outlier, trading at a level that, in the past, has usually been followed by pretty poor returns.
And when you dig a little deeper, you find a market that is dangerously imbalanced. It turns out all the growth is coming from just a tiny handful of tech giants, the Magnificent Seven, companies like Apple, Microsoft, Nvidia, and Amazon. Their earnings are projected to soar by 26%, but for the other 493 companies in the index, their earnings are basically flat. The entire market is pretty much being propped up by just a few stocks.
So this brings us right to the core of it all, the direct parallels. When you put the dot-com era and the AI boom side by side, the similarities aren't just a little spooky. In some really unsettling ways, they look structurally identical.
Back in the 90s, the big bet was on fiber optic networks. Telecom companies spent $500 billion laying cables that nobody was using yet. Today, the big bet is on data centers. And just like back then, the way it's all being funded is raising some serious eyebrows. The dot-com era had this thing called vendor financing. And today, we have its echo, circular financing.
This is such a critical point. So imagine this. Microsoft invests $1 billion in an AI startup. That startup then turns right around and uses that exact same money to buy cloud computing services from, you guessed it, Microsoft. So Microsoft gets to book it as new revenue, the startup gets the computing power it needs, and it creates this perfect, self-contained loop that looks like a booming organic demand. It's a financial engine that can create the illusion of massive growth even when real paying customers are still just trickling in.
And the numbers needed to actually justify all the spending are just staggering. For the current investment levels to make any sense at all, the entire AI industry needs to grow its annual revenue from about $20 billion today to $2 trillion by 2030. That's more than the entire GDP of Canada. It means things like AI personal assistants have to become multi-hundred-billion-dollar markets practically overnight. We're talking about a 100-fold increase in just over 5 years. It's a really tall order.
So let's say the skeptics are right. What if this bubble does pop? Is it all just doom and gloom? Well, history suggests the answer is a lot more complicated and, frankly, a lot more fascinating than that.
Because here's the thing. The dot-com crash wasn't the end of the internet. Not even close. But the way the winners and losers were sorted out was completely counterintuitive, and I think it holds a really powerful lesson for what might happen today.
Think about it. The companies that spent billions building the fiber optic backbone of the internet, the infrastructure builders, most of them went bust. But their failure, their folly, it became this incredible gift to the world. They created a massive oversupply of bandwidth that made internet connectivity dirt cheap. And who benefited? The next wave of innovators, the infrastructure users like Google, Amazon, and Netflix, who built their entire empires on top of that cheap, abundant foundation that the bankrupt companies had left behind.
And this quote from a venture capitalist who lost 90% of his net worth in the crash, it just captures this paradox perfectly. He argues that this kind of wild speculative mania is almost a necessary evil. It's the irrational exuberance that gets investors to fund these massive, crazy projects that lay the groundwork for the future, even if those original investors end up losing everything. It's a powerful reminder that progress is often really messy, and sometimes the biggest failures are what pave the way for the biggest successes.
And that leaves us with the ultimate question, doesn't it? Is the current AI frenzy a reckless bubble built on pure hype, doomed to crash and burn? Or is this massive, perhaps irrational, wave of investment the painful but necessary price we have to pay to build the infrastructure that will power the next 50 years of innovation? History suggests it might actually be both. The only thing we know for sure is that the world is about to change big time. The real question is, who's going to be left standing when the dust finally settles?